Hello, everybody. Today we're going to tackle a pretty interesting question. And it says, Greg, how come if the economy is just kind of limping along, why is the stock market at all-time highs? What's with this disconnect? All right, well, let's start with the economy. Then we'll spring to a couple of possible explanations about the disconnect. So let's start with the headline out of today. Many of you probably saw Macy's is going to close another 150 stores, including their flagship store in Union Square in San Francisco. Okay, that's a lot of layoffs over a pretty big firm. And 2024 isn't actually off to a very good start employment-wise. Let me just read some names to you. You probably haven't heard of some of these firms, but they're Silicon Valley tech firms. Everbuddy, Wisense, CodeC, Twig. They're closing their doors completely. 100% layoffs. Twitch is getting rid of 35% of their workforce. Roomba, 31%. Bumble, 30%. Hasbro, the toy company, 20%. The LA Times, 20%. That's just a small list of what's happened just in 2024. Plus, we have what's happened over the last couple of years, and you'll recognize these names. Let's see, we've got Gold's Gym filed for bankruptcy, Neiman Marcus, Hertz, JCPenney, GNC, the vitamin guys, Pier 1, Belks, they started in 1888, they closed their doors, Revlon, David's Bridal, Bed Bath & Beyond, all filed for bankruptcy. And yet the stock market keeps going up. Well, let's keep going. The leading economic indicators, that's what we all used to watch back in the day, it's screaming recession. And yet the markets continue up. And by the way, it's not just here. It's in Great Britain, it's in Germany, it's in Japan. Those three are all in recession. They've admitted it. And yet the markets keep going up. So here are a couple of explanations, and I'll let you decide which one makes more sense. Number one is bad news is good news. Well, Greg, with all this horrible stuff, central banks, the Federal Reserve here in the US, we're going to have to lower interest rates. That will stimulate the economy. That's just the stock market is seeing this coming in the future. Thus, they're reacting in advance. Okay, I get that, heard that a lot over my career. Here's another one, though. And that is we have a structural problem that has emerged over the years, and it's called passive investing. So what does this mean? Let's pretend you work for PNM. And you don't know a whole lot about investing, but you know you got to put money into that 401k plan. So the human resources person comes in, the finance guy comes in, the financial advisor, and they say, look, why don't you do this? When are you going to retire? Oh, 2050? All right, we've got a fund for you. It's called the Target Fund. It's the 2050 fund, and so it's going to be pretty aggressive because you're not retiring for a long time. A lot of that fund is stocks. Now, if you're going to retire in 2030, it'll be more conservative, but you get the idea. And it seems very easy to you, and you think, okay, good. Check it off, take money out of my paycheck, let's just throw it in there. This happened all across America, where really there wasn't much thinking anymore going into how these portfolios are put together. We're just going to throw your money into the market, into the market, into the market. So every 2 weeks, every payday, we see billions of dollars flow kind of mindlessly to the stock market. Now you would think that that money might go in kind of equitably, but it doesn't. These indexes is what we call them. They're weighted. So for example, in the S&P 500, well, those are the 500 biggest companies in America. You'd expect if you put $1,000 in, maybe they divide it up evenly. They don't do that. What they do is the big companies get more than the little companies. It's weighted toward the big guys. So for example, let's say you put $1,000 into your target fund that's going into stocks. 75 of those $1,000 are going to go to Microsoft. 25 cents is going to go to Delta Airlines. Whoa, wait a minute. So what happens here? The money all flows up to the big guys. The big guys get more money, which makes them go up more. And then they get more so that next time they get more when you put money in. You see how this is a self-reinforcing mechanism? So this year, We have the value stocks. What are the value stocks? Well, those are the ones with the solid earnings, the ones that might pay a dividend. They're kind of boring companies. This is what we used to invest in. Well, those stocks are down 4 to 5% this year because they're not the high-tech growth guys that are getting all the money. So what we have is this odd thing where we keep rewarding a smaller and smaller group of stocks. So just to play this out to the end, you probably have heard of the Magnificent Seven stocks over the last few months. These 7 stocks in the S&P 500 have been hauling the whole wagon. NVIDIA, Apple, Microsoft, Amazon, Tesla was in there. Anyway, it made sense. They keep getting all the money. Well, now we're down to 4 of those stocks. We have fewer and fewer stocks hauling this wagon. And we've talked about this before. It's narrow breadth. What you would like to have is 400 of the 500 moving forward together. That's not happening right now because structurally, this thing is built to reward just a few at the top. To me, that's a fragile market. So if you're looking for reasons for the disconnect, I think a lot of it is right there. And with that, I will turn it over to Walt.